Thanks. Good morning. We have with us MD CEO HDFC Life, Ms. Vibha Padalkar, and quickly on growth, ma'am, if I can quiz you, because growth has been stronger both for Q2, H1. So, does your full year guidance therefore change? Does it give you more confidence to hike your growth guidance?
Yes, we are fairly happy with our growth in H1, and it has been fairly consistent at 31% growth in Q1 and in Q2, and hence in H1. Also, as a result, our market share has expanded to 16.3%, and very happy to share that we have reached a new watermark of 11% market share in the overall industry. This is the first time in this H1 that we have reached this watermark. So yes, holistically, quite happy with the level of growth. In H2, we will continue to go ahead and drive this momentum that we are seeing in our sector, especially after quite a few of changes, whether in taxation, whether in regulations, and so on. So we are fairly hopeful of driving this momentum. We should end the year at least at an 18 to 20% APE growth, and also slightly faster than the overall sector.
Point taken. What about value of new business, ma'am? What would that growth look like? You've upped your guidance on top line.
We have delivered value of new business growth of 17+%. We expect on a full year basis at least to deliver VNB growth in the region or somewhere in the range of 15 to 17%.
And ma'am, margins have come off for you. You expect margins to taper further by end of this year, given the kind of growth guidance you're suggesting. It could see a further taper. Could you give us perspective as to why that is so? Because you're not meeting your guidance.
So a couple of things, like I've articulated, we want to take advantage of the growth momentum that we are seeing. At the same time, equity markets remain fairly buoyant. And we are following a strategy wherein we want to be where the customer is and offering products that the customer is enthused based on whatever is the economic environment that the customer is looking to buy. And hence, the level of unit link has gone up to some extent. Normally, it's about 1/4 of our business. It's hovering around 1/3 of our business and thereabouts, about between 33 to 36%. As a result of which there is some softness in our margins, but in order of priority, we are targeting new business growth followed by value of new business growth, like I articulated, in the range of 15 to 17%, and margin will be an outcome. Why are we doing this? We are doing this, like I said, because it is important that we get customers through the door. It's not that difficult for us to stay range bound to a particular margin, but that would just mean that we would have to say no to business that's otherwise accretive to value of new business. So triangulating all of these different objectives, we're saying that we will continue to grow. Another very interesting point is that of the new customers that we added this year, over 70% are new to HDFC Life, and that just revalidates our strategy to say that it is important to get the customers through the door to sign up in any which way with one of our policies, and thereafter to see how we can deepen our relationship with the customer. And that's exactly what we are successfully doing in this year.
So, ma'am, point taken, but where should margins therefore be at the end of FY25? Because you've guided for 100 basis point likely maximum impact in case as surrender value norms kick in. So where should therefore margins be? Do you expect a further taper of 100 bips due to the surrender value norms kicking in over and above what you're guiding for?
Yeah, so on margins, we ended last year at slightly over 26%. I had said that allow us to be range bound. It could be 100, 150 basis points lower as long as I'm able to give growth that I've demonstrated is higher than the sector. That's number one, as well as VNB growth. We've delivered 17% VNB growth. So that's if surrender regulations don't happen, we will continue to be range bound, like I mentioned, versus the margin profile last year. And just to put things into perspective, if I were to look at H1 of last year, unit linked was about 28% of our composition versus about 36% of our composition this year, and that kind of explains the softness in margins. This is, of course, without taking into account surrender charges. What we had mentioned is that if we did nothing, then the impact of surrender charges on a full year basis would be 100 basis points, on our margins. Now, obviously, we are not going to not be doing anything, and we are in conversations with our partners, and we will try and see how we can reduce this impact on our margins. But it will take about a quarter because we've just gone live with some of our products. There are these ongoing conversations with various partners that will crystallize and settle down in a quarter's time.
Right. So, ma'am, are temporary factors pushing you to shift focus away from margins? And my question, therefore, is will margins revert back to 25 to 26%? I understand timing may be fluid, but are you confident of margins coming back to 25, 26% plus?
Absolutely. Because I'm very confident that, the unit linked uptick that we are seeing is a market phenomenon. And as and when the cycle turns, and cycles will turn, we are fairly confident that our sales teams can virtually switch to various other products that we have in our arsenal, depending on whatever is topical at that point in time. And as that happens, margins can only move upwards from there because unit linked, as one knows, do deliver fairly low levels of margins. So it's just that triangulating between growth, margins, and value of new business, we do see any pull back on unit linked in favor of, it could be par, it could be non-par, it could be annuities, pension, whatever anything other than unit linked will mean better accretion to margins.
Fair point. You've spoken a lot about product mix, but is pricing at all causing a drag on margins?
So the drag was really in quarter two, in the last couple of months of quarter two, and I did mention this on the call that there has been an impact on a standalone basis in quarter two. There's been about 100 basis points impact on margin. This was a conscious call because these were on non-par products that were going to be phased out. Post the regulatory changes, they would have been phased out. Now we had to reprice those products, but we only would have ended up not being ready on 1st of October with the newly compliant products. So we prioritized 40 products that would now be compliant, and we are able to sell those products. Had we gone to reprice the old product, the old non-par product, then we would have had to prioritize and perhaps put a new product on the back burner, and we consciously chose not to do that. And that's had 100 basis point impact on standalone quarter two and about 30 to 40 basis points impact on H1. But that's been a one-off situation.
Right. So margins otherwise, ma'am, sequentially would have been flat. Is that the right way to look at it?
That's right. More or less, yes. We ended 25% in quarter one.
Yes.
And yes, more or less that would have been the case.
Right. And will you adjust for pricing in second half of the financial year? And therefore, is it right to understand that margins will recover and this is likely the bottom?
All things being yes, but unfortunately things are very fluid, like you mentioned, and so we'll have to see how the new surrender avatar, in terms of the new products, how that pans out, both in terms of conversations with some of our or most of our partners, 300 plus partners, as well as customer pricing. I'm hopeful that our peers are fairly restrained in terms of the kind of IRRs as well as the conversations with partners, as we will be. And so that should not cause inordinate pressure on margins. We don't expect it to, but we will know for sure as we progress in this quarter. And of course, the unit link will remain in the 30s, unlikely to go up to 50+%, like is fairly common amongst some of our peers, but it will still be somewhat elevated in the high 30s.
Okay, thank you so much, ma'am, for setting up a good perspective with regard to what's happened in Q2. Thank you so much for joining us this morning. Well, back to you, Neeraj.
Okay, Harsh, what stood out in this conversation?
Well, what really stood out, it seems, is that two pressures which is basically keeping margins subdued. One is the fact that you've got a huge shift in product mix towards unit link, and second is that product pricing hasn't been tweaked. If any of those change, likely margins will recover. Hopefully H2 should be a better quarter, and that seems to be even what analysts seem to be suggesting on the street, that H2 will likely be better for HDFC Life where margins is concerned. Growth, of course, extremely strong, so no concerns there.
Yeah, it's showing the way the stock is performing as well, up about 2.5%. So thanks, Harsh, for putting that into perspective and for that conversation as well. Vibha Padalkar, head honcho of HDFC Life, with us on NDTV Profit.